So I have a crude oil strategy that backtests for almost a year on 15-second charts. The market trades differently than it did 5 years ago, 3 years ago. There's some micro price movements and some of the patterns that we used even 10 years ago sometimes work better on smaller time frames. Now the opposite of those patterns from 10 years ago, because we're in such a mean reverting market. And so crude oil, the trend has been up. And so this is a long only strategy. And for the past year, this strategy looks like this. Lately, it's been sideways. It's been sideways before. You have drawdowns in here. And it has a very tight stop loss, a $300 stop loss per contract, 30 points. So your percent profitability is low. Whenever you have a tight stop loss, you're going to have more losers than winners, but your winners can be a lot bigger. You let this thing run. It's a raw strategy. It doesn't have a lot of exits. It exits at $300 stop loss or a 2 o'clock p.m. Eastern time, and you see nice entry and stop out on Friday because it does leave so much on the table based on this back test. You can't add a trailing stop, a break-even stop, a profit target, but just with the raw results, this is what this strategy looks like. And one way to trade crude oil, has a low drawdown, and so it doesn't back test going back 10 to 12 years. If I test it on 1 minute charts, the past year the results are pretty good. They're not as good as on 15-second charts. But before a year ago, crude oil had been in a longer downtrend, and so now I believe we're moving into an uptrend in crude oil. The markets are inflationary. Um, Anticipation of inflation in the markets and energy prices, and so um, there's a bias to the long side. It's easier. It's easier to day trade crude oil on the long side, in my opinion, than on the short side. So, and then when the trend is up, it makes it that much easier. But you see some of the trades here. The last two trades have been down, and so taking the next trade could be a good approach in a strategy like this. The trade before that, I captured a really nice trade. So 3 trades ago, it was up this much, about almost 1300 on a 1270 was the trade it got in on. It can trade as early as 7:30 in the morning, and so it traded at 7:39 Central Time, 8:39 Eastern, and took a long trade in here in this area, 69.40, exited up here, and then the next two trades were stopped out on $300 stop losses. But that is um, that is what I call QS, quick start. And you know, these markets move fast, and one of the concepts is to pick a direction, and we pick the long side, and we look for a small counter trend pattern, um, and then we go long on that counter trend pattern at a certain time of day to capture these moves. Because once you once a traditional trading system discovers the signal, the trend can be over because the moves are fast. They usually don't last that long. And so this is one way to approach this market. Crude oil has a lot of range, and it seems like there's a lot of opportunity, but it's still a very tricky and difficult market to trade. And this is one approach that's been working the last 12 months or so. And I have data intraday going back to 1018 for 15-second charts. And so this is one, I guess it's 11 months, not 12. So this is one approach that you could take to trade crude oil. If you want to trade crude oil, if you want to add this risk profile to your portfolio and you agree that crude oil is bullish, if you're bullish crude oil and you want to risk this, in this setup, you're risking $300 per trade and no more than one trade per day. So you're managing your risk very carefully, and you've had 2 losers in a row. And so if you look at the trade analysis, this thing keeps disappearing on me. Losing series. 2 trades in a row happens 19 times, and the next trade is 588. And then you could have up to 6 trades in a row. That's happened once. 3, 4, 5, 6 losing trades in a row are less frequent, but they can happen 7 times, 9 times, 2 times, 1 time. And so um, it could be a good time to start on a losing series of 2. And so that's what I'm taking a look at for myself tomorrow. and I'm going to make the strategy available to you on a monthly lease. It's an emerging strategy. Emerging strategies have short track records based on new patterns, anticipation of new patterns that will continue, and you should be willing to risk the worst case drawdown or slightly more, and then go from there and manage it based on what you know about the crude oil market. So that is quick start crude oil.